Hey everyone, welcome back to another deep dive. So, when you catch the evening news and the anchor announces that the central bank has just adjusted its interest rates, and you're sitting there wondering, what on earth does that actually mean for me? Well, today we're going to completely demystify central bank policy rates in this explainer. By the end of this, you'll know exactly how those massive boardroom decisions translate into real-world impacts on your money. We're going to break down the jargon, look at the actual numbers, and map out exactly how the Sri Lankan economy responds to these shifts. Because let's be honest here, this is the question we all really care about, right? What happens to my personal loan or my business's working capital or even my fixed deposit when these abstract news announcements drop? If you're a salary earner just trying to balance the everyday cost of living, or maybe a business owner looking to expand, you might feel kind of disconnected from macroeconomic policy. But I promise you, these rate changes hit your wallet directly. So here's our roadmap for today's explainer. First, what is the policy rate? Second, understanding OPR, SDFR, and SLFR. Third, how policy rates move the economy. And fourth, the direct impact on ordinary people. Okay, let's dive into this. Section 1. What is the policy rate? The main interest rate. In the absolute simplest terms possible, a policy rate is a massive signal. It is the primary master interest rate used by the central bank to broadcast its intentions to the entire financial system. Think of it as the starting point for literally every other interest rate in the country. When the central bank tweaks this single number, it sends this huge ripple effect through commercial banks, businesses, and eventually right down to the interest rate on your credit card or your savings account. It's basically the ultimate steering wheel for the country's financial direction. Actually, the easiest way to visualize the steering wheel is to think about the pedals of a car. The policy rate is essentially the brake and the accelerator for the economy. So, if inflation is running way too high, meaning prices are just skyrocketing, the central bank is going to raise the policy rate. This acts exactly like slamming on the heavy brakes, making it harder to borrow and slowing the whole economy down. Conversely, if the economy is weak, sluggish, and desperately needs a boost, they lower the rate. That's hitting the accelerator, right? It makes money cheaper to borrow, so people go out, invest, and spend more. All right, moving on to Section 2, OPR, SDFR, and SLFR, decoding the acronyms. Now, the big one you need to know right now is the OPR, or the Overnight Policy Rate. This is currently the Central Bank of Sri Lanka's main policy signal. See, commercial banks are constantly lending money back and forth to each other overnight just to balance their books. The OPR acts as the target benchmark rate for those overnight money market transactions. It is the central anchor instrument guiding all other short-term interest rates in the market. And this framework brilliantly illustrates how the rest of the system supports that anchor. Alongside the OPR, we have the SDFR. That's the Standing Deposit Facility Rate. If commercial banks have excess cash just sitting around at the end of the day, they can safely park it at the central bank and earn this SDFR rate. It acts as a lower bound, a floor. On the flip side, we have the SLFR, the Standing Lending Facility Rate. If a bank comes up short and desperately needs liquidity, they can borrow from the central bank at this SLFR rate. And this acts as an upper bound or a ceiling. So while they aren't the direct policy signal anymore, the SDFR and SLFR create this defined safety boundary, a floor and a ceiling, keeping that main OPR right where the central bank wants it. Which brings us to Section 3, Policy Rates and the Economy, moving the vehicle. Let's look at a massive, real-world data point. On May 26, 2026, the Central Bank of Sri Lanka made a huge move. They hiked the OPR by 100 basis points. Now, 100 basis points is just financial jargon for a full 1%, bringing it up to 8.75%. And following those boundaries we literally just learned about, this pulled the deposit rate floor up to 8.25% and the lending rate ceiling up to 9.25%. Now, what's really fascinating about this data point is the sheer magnitude of a 1% jump. In the central banking world, a 1% hike all at once, that is a very firm, very aggressive step on the economic brakes. So, why did the CBSL feel the need to step so heavily on the brakes in May 2026? Well, it wasn't arbitrary. They were looking at a combination of really intense pressures. First off, headline inflation was creeping up, hitting 5.4% year-on-year in April 2026. On top of that, global energy prices were high, credit growth, meaning the amount of money people were actively borrowing, was expanding way too rapidly, and import demand was surging. All of this combined was putting dangerous depreciation pressure on the Sri Lankan rupee. Basically, the dashboard warning lights were flashing red, so the central bank hit the brakes. To really understand the impact of that decision, let's contrast our two scenarios. When you have a rate hike, like stepping on the brake, loans become noticeably more expensive. And because borrowing costs more, consumer spending and business expansion naturally drop. The benefit here? This drop in demand cools off inflation and can actually attract foreign investment, which supports the rupee. Now contrast that with a rate cut. Hitting the accelerator, loans become cheaper. Businesses suddenly want to invest in new machinery or open new branches, and consumers take out housing or vehicle loans. Economic growth shoots up. But the risk, of course, is that if demand outpaces supply, inflation comes roaring right back. This entire process is called monetary policy transmission, and it plays out like a giant game of dominoes. Step 1, inflation rises. Step 2, the CBSL reacts by hiking the rate. Step 3, because the cost of funds for banks goes up, borrowing drops. People literally cancel or delay their loan applications. Step 4, overall demand in the economy slows down because there's just less money sloshing around. And finally, Step 5, with less demand chasing goods, prices stabilize, and inflation is controlled. But keep in mind, this is not an overnight fix. Watching these dominoes fall can take several months to fully work their way through the economy. So, the crucial point is Section 4, impact on ordinary people, hitting your wallet. This is exactly how it hits your wallet. If you have a housing loan with a floating interest rate, a policy rate hike means your monthly installments are likely going to go up. It literally becomes more expensive just to live in your home. However, if you are a saver, well, there's a silver lining for sure. Fixed deposit and savings account returns generally go up, meaning your parked money is earning more. For business owners, the cost of working capital fluctuates wildly with these rates, which can honestly be the difference between turning a profit or taking a loss for the quarter. And if you're a standard salary earner, these rates dictate the broader cost of living and the strength of the job market. Because if borrowing is too expensive and businesses stop growing, new jobs just disappear. When you put it all together, it becomes incredibly clear. Policy rates are not just dry, technical figures meant for economists sitting in ivory towers. They are the pedals controlling the speed of absolutely everyone's financial life in Sri Lanka. Whether it's the OPR acting as the main signal or the resulting shifts in inflation and currency strength, every single time that rate changes, your financial environment changes right along with it. We've covered a ton of ground today, from the macro mechanics of the central bank to your personal wallet. But this is a massive topic, and there is always more to unpack. So as we wrap up this explainer, I want to turn it over to you. Looking at your own financial goals right now, what is impacting you the most? Do you want our next breakdown to focus deeply on maximizing fixed deposit rates, navigating changing loan rates, or maybe strategies to protect your income from inflation? Let us know, and we'll dive right into it next time. Thanks so much for learning with us today.